So today we are solving question number 20. I think it's 7 or 28, something like that, of Zack. Okay, so that's from SPR's exam kit. So it's question number 28. And then basically a Zack is uh, on February 20x2, an intercity train operated by Zack did what appeared to be superficial damage to a storage facility of a local company. So an intercity train operated by Zack did what appeared to be superficial damage. The directors of the company expressed an intention to sue Zack, but in absence of legal proceeding, Zack had not recognized a provision in its financial statement to 31st March 20x2. Okay, happened in February, March. Okay, that's the ending period. In July 20x2, January, February, March, April, May, June, July, right? Okay. I received notification of damage of 1.2 million, which is based upon the estimated cost to repair the building. The local company claimed the building was much more than storage facility, as it was a valuable piece of architecture which had been damaged to a greater extent than was originally thought. The head of the legal services advised Zack that the company was clearly negligent, but the view obtained from an expert was that the value of the building was 800,000. Zack had an insurance policy which would cover first 200,000 of such claims. After the financial statement for the year ended 31st March 20x2, after 1 year, were authorized, the case came to court and the judge determined the storage facility actually was a valuable piece of architecture. The court ruled that the Zack was negligent and awarded 300,000 for the damage to the fabric of the facility. So what are we required to find out? Advise the directors of Jack as to the correct accounting treatment of the above in financial statement for the year ended 31st March 20x3, right? So when did they receive the notification? July 20x2. On this date, they should create a provision, right? Okay, so let's explain IS 8. Not IS 8, I mean IS 37. Provision, contingent liabilities, and contingent assets. States that an entity must recognize provision comma and only if a present obligation which could be legal or constructive has arisen as a result of past event which could be obligating event. Next is payment is probable and the liabilities can be measured reliably. Can be measured reliably. Right? A provision should be made on the date of obligating event, which is the date on which the event takes place. Okay, not on that date, but it's on this date. I forgot. Yeah, it's this date. Okay, February 20x2. That results in an entity having no realistic alternative to settling the legal or constructive obligation. The obligating event took place on, when did it take place? March 20x2. However, it is reasonable that 31st March 20x2 to assess the need for a provision to be immaterial because the damage to the building seemed superficial. In the year 31st March 20x3, as a result of legal arguments supporting the action, Zack must reassess its estimate of the likely damages, and a provision is needed based on the advice that it has regarding the settlement. So provision should be reviewed at each year for material changes to the best estimate. So in the earlier year it was just immaterial, right? It seemed superficial damage, that's why we considered it immaterial, whereas now okay, So what should we do basically for provision? How much are we creating provision? Profit or loss? Credit provision. How much did the expert say? Obtained from expert was 800,000, right? And insurance will be reimbursed, okay? So net will be 600,000, right? So what we will do is 800,000 for same amount, right? Potential for reimbursement is basically insurance payments to cover some of the expenditure required to settle a provision can be recognized only if the receipt is virtually certain, right? Certain if the entity settles the obligation. IS 37 requires the reimbursement can be treated as separate asset. Company seems confident that it will satisfy the terms of the insurance policy and should procure for the reimbursement. So how will they basically do is that debit receivables, credit here, right? How much amount will be there? 200,000. Same thing over here as well. 200,000. All right. The court case was found against Zack, as this was after the authorization of the financial statement. As such, for the year ended were authorized after the court scheme, right? Okay. As such, IAS 10 events after reporting period. So there will be non-adjusting and adjusting, right? And adjusting event. Okay. So let's move on to question number B. Alright. Okay, the directors have discovered that some accruals were double counted within the trade payables balance as at 31st of March 20x2. This meant that expenditure for the services was overstated for the prior year financial statement by 2 million. Okay, Zack has since reviewed its accounting systems and processes and has made appropriate changes. It has introduced additional internal controls to ensure that such estimation problems are unlikely to occur. The directors of Jack are aware that they should follow the requirements of IAS 8 accounting policies, changes in accounting estimate and errors when selecting or changing accounting policies, changing accounting estimates, and correcting errors. They are also aware that board has issued exposure draft ED 2018-1 accounting policy changes to address growing criticism of IAS 8. So basically, what is the argument in this exposure draft is that the restatement of error from retrospectively as if it never occurred should not happen. That's what its basically main criticism is. So discuss the correct treatment of Jack's accrual errors in the financial statement for the year ended 31st March 2023. Discuss the role of the judgment when selecting an accounting entity's accounting policy. Why? When it provides a more relevant information, or it is more faithful representation of assets, liabilities, income, expenses, or equity movements. Okay. So discuss potential criticisms of IAS 8 and any proposal from the board address this criticism. Usually answer review to board's exposure draft. Okay. So first of all, accrual error, right? Second thing is regarding selection of accounting policy. Third is about exposure draft, isn't it? Criticisms, first of all. Criticisms here. Criticisms. IS 8. And next is exposure draft. Okay, now our skeleton is ready. Let's go into the inside. The system. The system's error has resulted in a prior period error. So as per IS 8, policies changes in accounting estimates, and errors requires prior period to be amended retrospectively by restating comparatives as if the error never occurred. So what we will basically do is we will correct the retained earning. In this case, it has been understated, right? So how will you do that? In order to correct the error, Zack should restate higher year information for the year ended 31st March 20x3, right? No, for the year 20x2. X3 is this year. Yeah. As such, hence in the statement of profit or loss and other comprehensive income must be reduced by $2 million as a result. Brought forward, PROUGST brought forward the retained earning in the current year statement of changes in equity should increase or will increase, you could say, after that will increase by $2 million. Additionally, the trade payables figure in the prior year statement of financial position should be reduced by $2 million, right? Next thing is regarding changes in accounting policy, right? Okay. Entities should follow, this marks was the earlier one. 4 marks. Okay, this is 7 marks. Follow the requirements of this, right? When selecting or changing accounting policies. An entity should determine accounting policy to be applied to an item with direct reference to IFRS standards. First of all, we need to consider what it says in the IFRS standards. However, an accounting policy will not be applied if the effect of applying them would be immaterial. So you might say, what is materiality again? So materiality is judgmental, but the board have issued a practice statement provides guidance in this area. So accounting policy will not be applied if the effect of applying them are immaterial. Okay. Entities must select and apply their accounting policies consistently for similar transactions. If specific IFRS standards permits different accounting treatment or permits different accounting policies for categories of similar items, an entity should apply an appropriate policy for each of the category in the question and apply this accounting policy consistently for each category. Okay, so that means like for the entire class of assets. Okay, suppose you are using PP, so some PP can't be in cost model and then other can't be in fair value model. That's what it basically means. For example, let's give an example as well. For example, for different classes of property, plant and equipment, some may be carried at fair value and some at historical cost. Okay, so that depends on the business model as well, but for the PP which is in the same category or for similar item should use same policy, okay, and consistently for number of years. They cannot change every now and then just because that will overstate the assets, so it'd be misleading. Okay, The conceptual framework. Conceptual framework provides guidance when an accounting standard offers choice of measurement is preparers should ensure that the resulting financial information is useful to primary users. In other words, the measurement base selected should provide relevant information and faithful representation of the underlying transaction. Okay. Provide relevant information. What should happen? To provide relevant information, preparers should consider the nature of the asset, whether it will be sold frequently or not, or liabilities being measured and how it generates cash flows for the entity. Okay. And then since we've talked about it, so let's talk about that as well. A measurement base that has a high level of uncertainty measurement uncertainty may not provide faithful information or faithful representation such decisions clearly involve the exercise of judgment and consideration will be given to the information requirements of the entity is user groups. These will vary between entities. So in case of reliable information, when will be whichever provides the we should consider the nature of the asset and then how it generates cash flow, and then the measurement base will only if there is high level of uncertainty for the measurement base, then that will not provide faithful representation, right? Sorry. And such decisions will involve the exercise of judgment and consideration as per the entity. Okay. Where IFRS standards do not specifically apply to a transaction, judgment should be used in developing when it does not specifically apply to a transaction. Okay, in developing or applying an accounting policy which will result in useful financial information in making the judgment. Entities must refer to guidance in specific IFRS standards that deal with similar issues and then subsequently to definitions and criteria in the conceptual framework. So first of all, we look at the similar kind of IFRS standard. After that, what we do is that we look for the definition and criteria in conceptual framework. Okay. Additionally, the entity can refer to recent pronouncement of other standard setters. Okay, not only IFRS but other standard who use similar conceptual framework. So let's talk about this as well. What is the criticism of IAS 8, right? So potential criticisms of IAS 8. Okay, IAS 8 requires prior period errors to be amended retrospectively by restating the comparatives as if the error never occurred. Hence, the impact of any prior period errors is shown to retained earnings rather than being included in current period's profit or loss, right? Preparers of financial statement could use this treatment for prior period errors as a method of manipulating current year earnings, right? A change in accounting policy for IAS 8 is also dealt with retrospectively. However, this can prove time-consuming and costly. Entities may decide to retain their current accounting policy even though a change might result in useful information for user groups. Due to the cost and the time consuming, like because you have to retrospectively restate all the values, like from very, like for 3 4 5 years, so that will take a lot of time, right? So that will be a disincentive for doing that, even though if the new policy might provide better information to the users, right? A key issue with IAS 8 is that the definitions of accounting policies and accounting estimate are not clear enough, and so distinguishing an accounting policy from an estimate can be difficult. Changes in accounting policy are dealt with retrospectively, whereas changes in accounting estimate are done prospectively. So being able to distinguish policies and estimate is important, right? Otherwise you could be using the same thing for the other. Otherwise you could be using prospective for changes in policy, right? The lack of clarity leads to inconsistency in practice and may also impact comparability. So sometimes there might be mistakes, right? Or someone might be using something else, someone might be using thinking that there is estimate and then using prospective, whereas someone might be thinking it's policy. So what is the exposure draft? Is that basically it says the IFRS interpretation committee's role is to respond to questions about the application of IFRS standards that are submitted by stakeholders. If the committee concludes that the existing IFRS standards is adequate, then they publish an agenda decision This details the reasons why the IFRS standard does not require revision, but also explains how best to apply the standard. Agenda decisions therefore provide helpful guidance and best practice. Okay. As a result of an agenda decision, an entity may wish to and as a result of agenda entity may wish to change an accounting policy but be deterred by the time and cost involved in retrospective application in ED 2018/1, right? Accounting policy changes, the board proposes that an accounting policy change resulting from an agenda decision made by the IFRS Interpretation Committee should be implemented retrospectively so it can be resulting from an agenda decision made by the should be implemented retrospectively unless it is impracticable to do so, which could be due to lack of data for a longer period, right? Or cost of working out the effect of the change exceeds the benefits to the users of financial information or financial statements. So this is pretty much it for this question, I guess. Yeah, I think we've covered it, right? So next question that we will be looking at is MACVIC, which will be question number 29 from SPR's exam kit. So if you have any questions until now regarding SPR's, any sort of question, anything that you would like to ask, please do comment down below. I'll definitely be looking forward for your comments. Until next time, bye bye.